Hey traders, this is Blake Morrow with Traders Summit. With me today, I have Mr. Jim Welsh. How are you, Jim?
I'm doing good, Blake, and I hope you're doing well as well.
I am. It's Friday, and it's the time that you and I get to catch up. And I'm going to say it. You know, hats off to you. You have been telling us for weeks. Now, I won't even say weeks. I want to even go back like a couple months. You've been hard pressed by saying, "Hey, we're going to drop below 4,000 in the S&P. We're going to hit like." I forget what the numbers you use. You can tell me here in a second, 3,850, 3,900, somewhere down there. And I'm like, yeah, I don't know if we're going to get all the way back down there. And we did. And we've turned as you predicted, but you also have predicted that we're going to go to all-time highs. So I'm going to ask you about that too, but I just want to say, Great job. Technically. I mean, we really hit those levels and bounced aggressively. So what are your thoughts here?
Well, again, the target was 3850, which is a 382 retracement from the low of March 2020 to the high in last January.
It was a 20% decline off the highs too,
and almost just about a 20% decline.
Yeah.
Last week when we talked, we covered this. I said, well, S&P getting under 3,900 is probably a good place to start adding some money back into the market. I think this rally was somewhat anticipated. Well, put it this way. I did 2 conference calls with financial advisory groups yesterday. So if you're a financial advisor, I would like to, find out more about that kind of stuff. Jim Welsh Macro at Gmail. What I said to them, Blake, was that sometime in the next 2 to 4 weeks, China is going to back off from their extremely stringent COVID shutdown rules.
Yeah.
And going to rejoice and rally based on that in the short run. At the same time, I think monetary policy and what's going to happen in the economy are more important issues, and they're not resolved yet. And we can kind of, maybe lead in and talk a little bit about that aspect. And we have, basically the Fed is going to continue to raise interest rates. We're going to get more evidence that the economy is slowing. You want to throw those bullet points up, maybe that would help.
Yeah, let me do that. I was going to say this is probably a good time for me to put up those bullet points that you brought to us, Jim, and let's talk them through.
Yeah, real quick. The Fed has been extraordinarily clear, doves and hawks, saying we're going to go to neutral. The neutral rate on the Fed funds rates is somewhere between 2 and 3. Powell's focused at 2.5, so we're going to 2.25 to 2.5. And they're going to do that irrespective of the fact the economy is going to be showing more signs of slowing. Again, Powell said, we can't do anything about the supply side. We want to address the demand side. So the economy slowing is exactly what they were hoping to achieve. Even as all this is progressing, we'll hear, speeches by Fed governors and presidents. We need to get to neutral. We need to bring inflation down. We're very confident we can do a soft landing. And as this starts to evolve, Wall Street analysts, which are still looking for 10% plus earnings, they're going to start to bring in their earnings down. And the point I've made the last few weeks is the first initial decline that we saw in the stock market is because 2-year and 10-year yields went up and you get a compression of PEs. I think the next shoe to drop is going to be as Wall Street cuts earnings estimates, we're going to see PE ratios come down a little bit more. And once the market is done and through that, then I think we have a better chance for a sustainable rally as opposed to these huge pops that run their course quickly.
Right. Well, these huge pops, they're also known as, short covering rallies or bear market rallies. Now, so let me ask you this. A lot of people have been really thinking that we are in a bear market. Do you agree, or do you think this is maybe the start of something new as we go to all-time highs? What are your thoughts?
Well, again, I think there's more weakness potentially to come after a rebound on this news because of the factors we just talked about. But I think what's going to be missed here, or maybe not anticipated, is as the Fed's going to raise the Fed funds rate 50 basis points in June, 50 basis points in July. But at some point in time, the rhetoric from the Fed governors and presidents is going to shift from we're fighting inflation, and they're going to start talking about, we wanted to get to neutral, and by the July meeting, they'll be pretty much almost there. We wanted the economy to slow. It's happening. We want to see inflation come down. And as you and I have talked for really since February, we're going to see inflation peak in either March and April and come down in the second quarter. It's not going to come down as much as I initially thought for various reasons, but nonetheless, inflation rates are coming down. So the Fed can say, hey, we're seeing that improvement. Hopefully some of the supply issues beyond their control. So even an inkling of improvement. And last but not least, the Fed has said, we don't want a recession. We want a soft landing. We don't want to hurt, those at the lower end of the income spectrum that would be unduly hurt in a recession. So my point is, we're going to see the rhetoric shift from, this hawkish tone to, hey, we're getting closer to the goals that we set out a few months ago. And also, as we all know, monetary policy acts with a lag of 6 to 12 months. The Fed can also make the point, hey, we've just raised the funds rate in 4 months, 200 basis points. And since we're seeing progress, we're at a place where we can slow it from 50 to 25. And so my point, Blake, is that there's going to be a shift in monetary policy as we get towards the summertime. And I think that is where, if we get another leg down because in earnings have been downgraded and so forth before this shift, it'll be a perfect setup for, I think, a really good rally. My call about going to new highs is predicated no recession. And I do think we're getting to the place where the Fed can potentially, talking about, hey, we've accomplished a lot of what we set out to do.
Yeah,
and
well, you're when you talk technically, I'm bringing up your S&P chart. We're actually a little bit higher than where your chart is. We're actually near 40-20, 40-25 at the time of us recording. This chart basically says that we're going to be rallying towards 4150, roughly 4200. Is that your thought process here?
You know how to read a chart, buddy. Obviously there's a lot of resistance as you go from 4150 to 4200. Look at all the lows that took place February, March. Obviously we tried to hold it in April, failed, and we got this plunge. So to me, this is a natural place for the S&P, very oversold. And there was a chart I forgot to send you. The internals, market breadth, is as oversold as it was back in January of this year. So you need a rally to relieve some of that. And then I think there's a retracement rally that has the potential to take us to lower lows. And you get, like in February, made lower lows, but that internal measure of breadth made a higher low. And that's, to me, what potentially gets set up here. So yeah, a rally towards 4200. And then I think there's more weakness that either retests 3850 or potentially takes us below that number.
And sentiment has been pretty extreme too. I mean, you got extreme bearish sentiment, and probably a lot of people position maybe even so poorly at this point that it could even extend a rally, closer to that 4200 versus 4100. You also brought in a chart of the TLT. Do you want to talk a little bit about that?
Yeah. Last week we showed this chart, and I said I think TLT could make it down to near 112 based on that blue line and lows going back a couple of years ago. And the expectation was a rally to 123. Yesterday, it rallied to just almost 119. It is pulled back. I think it's potentially an A. The pullback is a B, and we'll see another push up 123. What you can see on this chart, one of the potential patterns is, we got 1, 2, 3, 4, and now we're in wave 5. And we've completed at this week's low, wave 3 of 5, the bounce towards 123. And you can see back to 2018, that initial bounce back there was, just below 123. So that's another reason why that target. 123 and change is wave 4 of lesser degree within wave 3. So anyway, that's where the 123 comes from. But I think, Blake, one has to look at this and say, okay, we get a pop towards 123, and then potentially there's another leg down.
But let me just play devil's advocate here. What if it continues to rally? Would it be rallying on? Would it be rallying because people feel the economy is slowing, so yields are going to come down, or would it be rallying because everybody's risk averse and they're buying treasuries? What are your thoughts there?
I think the first thing, I mean, that was my take last week when we talked about this. I said, we're going to get signs of the economy slowing.
Okay.
And treasury yields are going to come down in response to that.
Right.
At the same time, later this year is really, again, if things play out as we've just discussed, and we get to a place where the Fed can slow the rate of increases from 50 to 25 and so forth, there's a pretty good rally that takes place in equities. I think that's the moment of truth out there somewhere, September, October, where we're either going to go into a recession, which would be bad for equities, or inflation comes down for a little while, and then some things, make it so now the Fed has to go above neutral. To me, that's key here, Blake. Since 1981, every peak in the Fed funds rate during a cycle has been lower. The last peak in 2018 was just below 2.5. So to me, if the Fed funds starts going above 2.5, I can't imagine that's going to be a good thing. That's simple.
Yeah.
So a lot of bobbing and weaving because a lot of things are tugging and pulling here, and it's going to continue. But I do think, again, the Fed has laid out its goals, and by July, June, we're going to see late June or so, the Fed will be able to start talking about, hey, we've made a lot of progress toward those goals. I think markets like that.
Okay. Well, we're talking about something that's really got the market's attention. Let's talk about the euro, or we could talk about the dollar. The euro just continues to get bludgeoned. We're actually at the 103.50, I believe, if I'm not mistaken. We're testing levels that we haven't seen since like 2017. Yeah.
Exactly. Now, when we talked last week, I said it looks to me like the euro has 1, 2, 3. The bounce we were seeing last week was 4, and that there was a drop below 104 coming. The two legs, when we looked at longer term chart, we saw two legs, and it got you down to near 104. The low in 2017 was 103.40. And so my point was, I think we're going under 104, and I think we're getting close to a tradable low in the euro. But as we've talked numerous times, the 5-day and the 13-day moving averages, the red and green, you got a divergence. So we're making lower lows. That's the first part of a lot of times trend changes. So you get a non-confirmation with the RSI. Then you need to see the 5 and 13-day moving averages cross, where the red crosses above the green. And, we're not there yet. But what I laid out last week was we go down, we make a lower low, you get divergences, and then we'll see what happens in terms of do the red and the green cross. And I think there's a decent chance of that happening, because of the technical chart aspects and so forth. And sentiment is really pretty negative, the euro. And so I just think we're at a place where it makes sense, not to be short and to be looking for an opportunity for a trade to the upside.
Well, let me ask you, let me ask you this, Jim, before we wrap things up. A lot of people have talked about the death of the dollar, and and obviously the dollar has just rallied in the face of everybody's naysayers about the dollar. Is the dollar going to continue to move higher from here, or do you think the dollar is probably near a longer term peak? Just talking about the dollar in general.
Yeah. Not yet. I mean, again, I understand where they're coming from. Well, look at the trade deficit and budget deficits, blah, 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 blah. But again, it's always relative to other countries, and things could be worse in other countries, which is obviously what's motored the dollar in the last 2-3 weeks, is because of what's going on in Europe and in Japan, the Bank of Japan, and what they're doing, right? So to me, the action of the dollar the last few weeks looks like some kind of a third wave, unrelenting, okay? And so you get a pullback toward 99.50 or something like that, which was an area of prior highs. And then I think you got another leg up before one could anticipate a more protracted pullback in the dollar. So again, the reserve status stuff, you got to look at global trade is still completely funded for the most part. I think it's like 65% of global trade is done in dollars. So is that down from where it was 20, 30 years ago? Yeah, but it's still, it's going to be very difficult for someone to replace all the aspects of the U.S. economy and financial markets.
Sure.
It may be the latter part of this decade, sometime we'll talk about the longer term outlook about things, because I think there's a significant peak coming before 2025 in the stock market. We're going to see a 15 to 20-year bear market. Things are going to get really pretty ugly.
Oh my gosh, Jim! I'm lucky I'm on the first floor. I'm going to be a jumper if you talk like that, Jim. Well, I'm not going to leave on. I don't want to leave on that note. Let's leave on a positive note. It's Friday, yes. and we can. That's actually fodder for a future conversation, which I think is a good conversation to have. So, Jim, if I'm not a financial advisor, but if I was, or if I'm a trader, just want to learn more about you, how do I do that?
Macrotides.com. And if you want a recent publication, because you're a loyal listener of Trader Summit, I'll be very happy to send you a most recent weekly technical review, Jim Welsh Macro at Gmail, and I'll send that out to you.
Awesome, Jim. Well, thank you so much for your time. Happy Friday to you. And thank goodness it's not 2025 yet. So
amen.
All right.
Let's party like it's 2022.
All right. Have a great weekend. And thanks again for joining us.
As always, thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.